Hi, welcome to the Tactical Futures class. I am excited that you're here. This is a big step. This is a big step in understanding how to utilize futures for income and wealth, whether you're looking for that short term account movement, you're looking for long term portfolio protection. Futures are a phenomenal asset class, and you are about to step into a brand new world. So I'm excited that you're here. Session number one, we're going to get rolling here. And our session number one is really just simply going to be an introduction to futures, right? An introduction to futures, and 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 we're going to look from a 30,000 foot view. So everything that we talk about today, we're going to look at from a 30,000 foot view. We're going to explain it in much greater detail throughout the additional modules of this on-demand content. So don't get lost in every single detail because we're going to explain everything as we move along. But this class is called Tactical Futures. So why do we call it Tactical Futures? What is Tactical Futures? The way I like to think about it is that you've got to have a strategy, an overarching strategy, and then there's going to be individual tactics inside of that strategy, right? So I think about it. I think about it like in American football. If you have a strategy that you're going to have a running game is going to be the core of your offense. You're going to run the ball, run the ball, run the ball. There's individual plays that you do. You might have different tactics of how you run, whether it's an I formation or a wing back formation or whatever it happens to be. So your strategy is the overarching approach that you take. The tactics are the individual things that you do that follow along with that strategy. Well, our overarching strategy comes from the strategic trader class. Hopefully, you all have taken and understand all of the concepts in the strategic trader class before coming into tactical futures. We're not going to dive into all of the concepts that we covered in the strategic trader class, but understand that in order to have a good futures trade, you first have to understand how to have a good trade, and that's what the strategic trader class does. Well, from once we have our strategy and we understand our strategy, then we branch off into our tactics. And that's why we have tactical options and tactical futures. And so the tactical use of asset classes layered upon our strategy is a key to being successful. Okay. So a little bit about myself. My name is Chuck Fulkerson. You guys probably heard from me in your strategic trader class. That's where the first class that is in this series of education. And so my background is I've been trading since 2005. And when I started back in 2005, I didn't know the difference in a stock and a rock. I was brand new to the financial markets. Spent some time really getting around really good traders and people that I know and like and trust and people that were able to show me some of the ropes. And I didn't start trading futures. I started off trading options, and options were really my baby, my wheelhouse for a while. And it wasn't until I'd been trading for about 5 years that I got introduced to futures. And it was mind blowing. It was completely mind blowing once somebody introduced me to futures. And that instructor who introduced me to futures showed me some of the benefits as well as some of the risks that are involved in futures. And that's what we're going to really focus on over the course of this on-demand content is what are some of the risks that you take as a futures trader? You've got to understand them. You have to understand the risks. But without risk, there can be no reward. So we're okay with a bit of risk provided that it gives me the right amount of reward for my positions. So today's session, Introduction to Futures, we're going to go 30,000-foot view. Everything that we cover today, we're going to cover in greater detail further on in the course. But what is a future? Futures are standardized contracts for the purchase and sale of financial instruments or physical commodities for future delivery on a regulated commodity futures exchange. That's a mouthful. So standardized contract, what does that mean? Well, that means that contract is standardized no matter where you buy it, no matter which broker you use, no matter who you buy it from, that contract is standardized. And it's standardized by the listing agency of that contract, which is the exchange, the regulated commodity futures exchange. And what's great about this commodity futures exchange is that it is regulated. So there's transparency in what happens. And it's a centralized futures exchange. Everybody connects to the same exchange, which is really one of the cornerstones of why this works the way it does. Now, most people, when I talk to them, their experience is not in the world of futures. Their experience is in the world of stocks. So I want to do a real quick comparison between stocks and futures so that we understand some of the differences. Futures are traded in contracts. And we already stated this: a contract is it's a standardized contract that allows control of a product. It allows control of a product. So when you trade a futures contract, you're controlling oil, you're controlling wheat, you're controlling corn, whatever it is you're controlling. Well, when you trade in stocks, you're trading in shares. And the share is actual ownership, right? So when I trade in shares, I own a certain number of shares of that company. Matter of fact, that company, that share represents ownership. Now, I might only, if I have one share and there's 300 million shares outstanding, I'm a 1/300th million owner, but I am still owner. It does represent ownership in that share. Now, since I have ownership in the company, as long as that company is in existence, my stocks have no expiration date. They are good essentially forever, right? That's why we have companies like GE and ExxonMobil that people have had in their portfolio for decades, right? Well, futures don't work that way. Futures, they will have different expiration times based upon the asset that you are trading. But every futures contract has an expiration, right? A futures contract is the obligation to buy or the obligation to sell a product at a certain price at a certain date. And so that certain date is the key. There is no such thing as an open-ended futures contract. It just doesn't exist. So in stocks, the minimum move is 1 penny. Whether you're trading Apple or Exxon or Starbucks or Microsoft or IBM or GE, it's always going to move a penny. Every stock moves a penny. Futures aren't like that. Futures will have minimum price fluctuations that change from product to product. So corn has a different minimum price fluctuation than oil. Oil has a different minimum price fluctuation than the S&P. The S&P has a different minimum price fluctuation than the euro does. And so these different assets will have different minimum price fluctuations. They're not all going to move at a penny a piece, right? Oil does move at 1 penny. Now we call that a tick because oil, when you think about barrels of oil trade at $53.28, right? We think of it as 53.28, and so it moves from 53.28 to 53.29 to 53.30, and so stocks don't do that, right? Stocks all move in 1 penny increments. Oil does. It's an easy thing to consider that they're very similar, but the S&P moves in increments of 0.25, right? So the S&P would go from 30,210.00 to 30,210.25 to 30,210.50. And so it's going to change based upon the asset that you're trading. And so as we go through this class, you're going to see that we show really what are the minimum price fluctuations for all of the different products. We even have a little bit of we'll call it a cheat sheet, a 1-page download that you can have, which will list most of the futures that are worth trading and their minimum price fluctuations. We said earlier, stocks represent ownership in the company, whereas futures represent control of a company. And when you can control something but not own it, there is a significant advantage to controlling and not owning in as far as capital requirement. So futures, like we said, are traded in contracts, and a futures, when they're trading contracts, they're an agreement between the buyer and the seller of a particular product. And each product will have 4 main specifications that we're going to talk about: settlement, size, expiration, and price fluctuations. Those are going to be the 4 main things. And once again, we're going high level here, so don't get caught in the weeds. Settlement. There are 2 types of settlement for futures contracts: physically settled and financially settled. So think about a physically settled futures contract. A physically settled futures contract means that they're going to physically deliver something to your door. That's really what it means. So you can physically deliver barrels of oil. You can physically deliver bushels of corn. You can physically deliver bars of silver. But you can't physically deliver NASDAQ, right? You can't physically deliver NASDAQ. You can't physically deliver yen. Those are what are called financially settled futures products. So we want to know that there are differences. In reality, we're not going to hold them to expiration in order to receive the settlement of those contracts anytime we don't have to. But that would be something that's important to know. The other one is, how big are the contracts, right? We talked about the fact that stocks always move in increments of 0.01. That's because each share represents one share. Well, one contract of oil represents 1,000 barrels of oil. Well, one contract of corn is 5,000 bushels. One contract of the S&P is $50 times whatever the S&P is trading for at that moment. So what you can see is that these futures contracts control what might be considered a rather large amount of an item, right? So think about it. If oil's trading at $50 per barrel and the contract controls 1,000 barrels, how much does one futures contract control? Well, one futures contract then controls $50,000 worth of oil. The third is the expiration. When will those futures contracts expire? Every futures contract expires. Some just expire more frequently than others, and they have more contracts what are called listed, right? So some contracts expire on a monthly basis. They're like crude oil expires. There's a new contract for crude oil which expires every single month. Some contracts expire quarterly. Every 3 months you get an expiration. And some go so far as to do it weekly, right? Where there's weekly expirations on these futures contracts. But your futures contract that you're going to trade you're going to mostly focus on the contract that is the most liquid to help you achieve your objectives, and we'll talk about that in a later segment. The fourth thing is, what are the price fluctuations? So the minimum price fluctuations. Now stocks are traded in shares, and their minimum price fluctuation is in dollars and cents. It's in cents, in pennies, if you will. Right? 0.01 is the minimum fluctuation for a stock. Well, in futures, the minimum price fluctuation is called a tick. It's called a tick. And so it's important to understand what is the value per tick and how many ticks are there in a given point. And so when I understand some of these price fluctuations and minimum areas, then I can start to truly understand what my futures contracts may be worth. Now, you might be hearing about futures for the first time, or you're brand new into futures. But understand that futures have been around for a really long time. The earliest recognized futures exchange is the Dojima Rice Exchange, established in 1730 for the purpose of trading rice futures. Western commodity futures started trading in England during the 16th century, And the first official commodity trading exchange in England, the London Metals and Market Exchange, was not established until 1877. So futures they're not a new invention. They've been around a really long time. And I know many traders that have had some sort of a horror story when it comes to futures. I also know many traders that have had success stories when it comes to futures. We want to focus on the latter, right? We want to focus on success stories. And how do we help you to get there? Well, you've got to understand what futures are and where they came from and why are they used. So we'll cover that in our next session. If you have any questions, as always, send us an email, support@tradersarmy.com. See you in the next session.